The U.S. markets are currently closed. As of the closing bell on Wednesday, October 15, 2025, shares of Nuburu, trading under the ticker symbol BURU on the NYSE American, closed at $0.11, marking a decline of 2.15% for the session. And while that single-day move might seem trivial for a stock at this price point, it's a symptom of a much larger and more urgent story. The expectation for a company like Nuburu, with its high-power blue laser technology, is one of exponential growth and industry disruption, particularly in the electric vehicle and electronics sectors. But the immediate reality is that the company is fighting for its very survival on a public exchange, a detail that often gets lost in the excitement over its technical specifications. The narrative you might find on forums or social media, a common starting point for those looking at online investing, is about how Nuburu's technology is essential for welding copper in EV batteries, a task where traditional lasers struggle. That story is true, and it's compelling. However, the far more critical story is the one told by the stock chart and the official SEC filings. The company is currently under a formal delisting warning from the NYSE American for failing to maintain a minimum average share price. This isn't just a minor administrative issue. It's an existential threat that fundamentally changes the risk profile of this investment. The general belief, particularly among retail investors using platforms like the Robinhood app or SoFi Invest, is that you're buying a piece of a future-facing technology at a bargain price. The logic seems simple. If they land just one major contract with a company building EV batteries, the stock will soar. This line of thinking compares it, perhaps unfairly, to the early days of other hardware innovators. But this perspective is dangerously incomplete. The challenge is that the market for industrial hardware is not like the market for software or consumer gadgets. Sales cycles are incredibly long, require immense proof-of-concept investment, and are subject to the capital expenditure budgets of massive corporations. So the question isn't just whether Nuburu's blue lasers are better. The questions are, can they manufacture them at a profitable scale? Can they convince a multi-billion-dollar corporation to rip out its existing manufacturing process and adopt theirs? And most pressingly, can they do all of that before their cash reserves are completely depleted? This is the stark reality that confronts anyone looking beyond the surface-level pitch, whether they're a self-investing enthusiast or a seasoned professional using the advanced tools on interactive brokers. Let's dissect the recent stock movement because it tells the tale far better than any press release. The slide to the 11-cent mark wasn't a sudden crash, it was a slow, grinding descent. This is characteristic of a stock losing investor confidence. The trading volume on many days has been relatively low, which points not to panic selling, but to apathy and a lack of institutional interest. Big funds, the kind that use sophisticated fidelity wealth management services or build complex positions via interactive brokers, typically cannot or will not hold positions in stocks trading this low, especially those with a delisting notice hanging over their heads. This creates a vicious cycle. The low price scares away large investors, the lack of large investors prevents any meaningful price support, and the price continues to drift lower, exacerbating the exchange listing problem. To solve the NYSE's price requirement, the most likely path forward is a reverse stock split. While this mechanically increases the share price, it does nothing to change the underlying value of the company and is almost universally viewed by the market as a sign of weakness. It's a cosmetic fix for a fundamental problem, and experienced investors know it. We've seen this play out time and time again with struggling tech companies, and the post-split performance is often grim. Furthermore, we have to talk about cash burn and dilution. Nuburu is not a profitable company. It is spending significant capital on research, development, and marketing. Looking at their recent quarterly reports, the net loss and rate of cash consumption are the most important metrics. To fund these operations, the company has had to raise capital by selling more shares. This is where the pain for existing shareholders comes in. Each new share offering dilutes their ownership stake. For instance, a private placement or a public offering, while while injecting necessary cash, increases the total number of shares outstanding, meaning your piece of the pie gets smaller. For a trader using a platform like SoFi Active Investing, this is a critical factor to monitor. The need for cash is a sword of Damocles hanging over the stock. Any positive news about a potential partnership is immediately tempered by the market's expectation that a capital raise will soon follow, putting a ceiling on any potential rally. This is a dynamic that separates a healthy growth company like Nvidia stock from a speculative pre-revenue venture like Nuburu. While Nvidia is generating mountains of cash, Nuburu is consuming it. So, what does Nuburu actually do? At its core, the company designs and manufactures industrial blue lasers. The key scientific principle here is wavelength. Traditional industrial lasers are often infrared, but metals like copper and gold are highly reflective at those wavelengths. It's like trying to heat a mirror with a flashlight. A lot of the energy bounces off, leading to inefficient and often messy welds. Nuburu's blue laser operates at a wavelength, around 450 nanometers, that copper absorbs with incredible efficiency, over 10 times more effectively than infrared. This results in faster, stronger, and spatter-free welds. This isn't a minor improvement, it's a significant leap in performance for specific high-value applications. The business model is to sell these laser systems directly to manufacturers in key growth sectors: electric vehicles for battery and motor production, consumer electronics for things like joining components in smartphones, and even in 3D printing for creating parts from reflective metals. The technology itself is sound and addresses a real need, which is why the stock holds any speculative appeal at all. Comparing it to another hardware giant, the appeal is similar to how investors look at Apple stock, not just for the iPhone, but for the underlying proprietary technology that makes it unique. The difference is that Apple has a globally recognized brand and a fortress-like balance sheet, while Nuburu is still trying to prove its commercial viability. Looking ahead, we're at a genuine crossroads, and the tension between the hopeful expectation and the harsh reality is palpable. The bull case, the dream that keeps investors holding on through Fidelity IRAs or a Robinhood stock trading account, rests on a few key potential catalysts. First and foremost is a landmark contract. If Nuburu could announce a multi-year agreement to supply lasers to a major auto OEM or a battery gigafactory, it would serve as the ultimate validation. It would prove the technology works at scale and that the economics are sound. Such a deal would likely send the stock soaring and solve many of its financial problems in one fell swoop. Another positive catalyst would be a strategic partnership or investment from an established player in the industrial technology space. This could provide not just capital, but also manufacturing expertise and a distribution network. Think about the need for perfect welds in a Tesla stock battery pack. The demand is clearly there. Resolving the NYSE listing issue in conjunction with such news would also be a major win, restoring a degree of credibility. For many managed portfolios, such as Schwab Intelligent Portfolios, holding a stock that is not on a major exchange is simply not an option, so regaining compliance is crucial to broadening its potential investor base. However, the bear case is equally, if not more compelling, and it is grounded in the current financial reality. The most significant risk is that the company simply runs out of time and money. If a major contract doesn't materialize in the next few quarters, and if capital markets become tight, they could face insolvency. The clock is ticking loudly. Competition is another major factor. While Nuburu has a head start in high-power blue lasers, they are not the only ones working on this problem. Larger, better capitalized competitors could develop their own solution or even acquire a smaller rival, effectively boxing Nuburu out. Finally, the delisting threat is very real. If the company is forced onto the OTC, over-the-counter markets, liquidity will dry up, it will become invisible to most institutional investors, and the share price could fall into even deeper sub-penny territory. Investing in a company in this position requires a very high tolerance of risk and is a world away from the relative stability of buying Fidelity ETFs or blue-chip stocks. With the EV industry being so central to Nuburu's story, it's worth asking a direct question. Comment below what you believe is the biggest single reason a major automaker has not yet signed a large-scale public deal for this technology. Is it cost, a reluctance to change existing manufacturing lines, or something else entirely? In summary, the story of Nuburu is a classic case study of expectation versus reality in the world of deep technology investing. The expectation is fueled by a genuinely impressive technology that solves a critical problem in a booming industry. It's a narrative of innovation and potential that is easy to get excited about. But the reality is one of precarious financials, immense shareholder dilution, and a desperate race against a ticking clock set by both their cash burn and the exchange's compliance officers. For anyone engaged in online investment, from those using Fidelity investments to those on